Good morning and welcome to the Open here on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us today. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Dollarama is reporting increased revenue and profit for this morning, beating expectations. The Canadian discount retailer's first quarter sales increased by 21%, while profit jumped 17%. The company continues to see growth. 22 new stores open in Canada, another 8 are opening in Australia. Transat AT reported weaker than expected second quarter results. Revenue was down 0.3% from last year, while adjusted profit also saw a decline. The operator of Air Transat has been affected by the fuel crisis caused by the war in Iran. Transat also says it plans to apply for the new federal funding program to offset the impact of fuel costs. Oracle shares are down in pre-market trading despite beating revenue and earnings estimates. The software company's revenue was up by 21% in the fourth quarter. It also raised its profit forecast for the year. However, investors seem to be showing concern about the company's plans to raise more money to finance its build-out of data centers for AI. Oracle says it foresees raising an additional $40 billion through debt and equity financing. And taking a quick look at the markets right now, and it is shaping up to be a bit of a struggle. We'll see what happens right now. They are up for now, but they've got some pressure coming in with the PPI that just came out. And right now you can see the NASDAQ is up 0.79%, rallying on the hopes that they're buying the dip. S&P 500 also up by 0.44%. TSX from yesterday. And it took a slight hit yesterday, but is still up over the last year, nearly 13%. And the other one we're keeping an eye on with concerns about what's unfolding in the Middle East, threats by the U.S. president. You can see oil is up slightly right now. We'll see what happens for the rest of the day. It's up above 90 a barrel, though, for WTI. Well, the S&P and NASDAQ are in the green today as investors buy the dip following the sell-off of chip makers over the last few days. Our next guest says he's a buyer on this weakness as well, but choosy about it. Joining us now is Dan Rohinton, portfolio manager at IA Global Asset Management. Dan, always good to see you, sir. Thanks very much for joining us.
Good to see you, Roger.
All right, and just the day has kind of gotten a little more interesting, hasn't it, with the reports out of Washington now that the president's saying ready to launch more attacks. How are you taking all this right now? Where are you? What are you doing right now?
Yeah, I mean, taking a step back, when it comes to energy prices versus semiconductors, it's really, tomatoes and oranges. There's really no comparison that really matters. And the reason I say that is at the end of the day, what drives the semiconductor stocks and the record run that they have seen, and it should be taken in stride how strong the performance has been recently, has been the belief that CapEx is going to continue to rise and forward estimates are moving even further and further out. So what used to be a maybe peak cycle a year from now or 2 years from now, people are talking 3 years from now. So that's really what's been driving the strength. And now there's more supply coming on the market. Think SpaceX this morning, and then also more equity raises by the big companies. It starts raising those questions of, well, how much more can you fund? And if that's the case, then eventually supply catches up and the super cycle profits that we are expecting to earn for some of these companies, maybe they don't last that long. So we're in that jittery phase, but we should take stock of the fact that this was the last, call it, one of the best months in the prior 2.5 decades for these stocks. So volatility is, the price of admission for these types of companies, no question.
It has been quite the last. I mean, since the start of the war, and then the recovery has been. It's been a rocket launch for so many of them. So, you're being fairly focused on what you're looking at, though, aren't you?
Yeah, and the best way to think about it, and I think I do want to emphasize one more point, Roger, if I may, is the way that energy prices will have an impact on tech stocks and semiconductor stocks outside of whatever is going on inside the AI conversation in its own hermetically sealed container is inflation pushing to higher interest rates, pushing to lower discount rates for equities. That's how I see that transmission from anything oil related or conflict related. But specifically to what we see as the opportunity in the here and now, I think it's important to think about when you see the real animal spirits come out. Some of the biggest companies that are the best positioned over time tend to be left in the lurch. So you can buy Nvidia at a cheaper multiple than RBC by a decent proportion now, like about 10-15% than a lot of the other companies. So I wouldn't sleep on Nvidia. I wouldn't sleep on Avago. And the reason for that is they're the through line for all of this major spending to come through. So although memory's seen a huge expansion in margins, 80% margins is pretty good. You can't really go much higher than that, and you kind of just have to hope these stocks go longer in terms of their supernormal profits. But when you're talking about an Avago, when you're talking about an Nvidia, a lot of that same conversation exists, but the belief that the persistency isn't there for these companies, I think, is a lot tougher to come around than the idea of a super cycle in memory eventually going into a bust, like it has been in many other instances.
Why do you think it's a lot tougher then? What are people worried about with Broadcom?
They're worried that they didn't upsize the TAM. So what's interesting about the recent volatility in semiconductor stocks, it actually started with Broadcom, because they basically said, we're not going to change our $100 billion revenue estimate for next year, for this year, and we'll update it in the future. When some of the expectations were 130 billion, 140 billion, that was basically, I would call, an expectations miss in the quarter, and that then cascaded across the rest of the semiconductor space because animal spirits were really at a fever pitch. But take a step back, they are going to keep accelerating. They are being conservative. Same with Nvidia. So if you could buy these companies at teens PE multiples or less with clean balance sheets, that is probably the best place to be in the broad ecosystem, because you always run the risk of further downsides, further pressures. So you want to be dominant in your value chain as you're owning these things through. And that's why we go to where we do, which is Nvidia and Avago, especially in semiconductors.
All right. And the one I think everybody's talking about, SpaceX. What are you doing with that? Would you buy if you had the chance?
Look, I think, as with a lot of Elon companies, you kind of have to, suspend belief. So when we were sitting in on some of the teach-ins and the road shows for this, it's interesting to see, call it folks who sharpen their pencil on everything, talk about reusable rockets, extraterrestrial space travel, mass drivers on the moon, and having to put numbers on that. So I would just say, this is a universal good if SpaceX is successful. For you to believe that the IPO is something you own for a protracted period of time, I would say measured longer than days, longer than weeks, in months, quarters, and years, you have to believe that Starship is reusable. I can't believe I'm saying that, which would be a feat of humanity, for one. Two, and you have to believe that Starlink, which is the current profit driver, they can actually push that and take over a huge portion of the telecommunications profit pool around the world to get to the valuation, making a lot of sense from here. All of those things are directionally heading in the right place, but whether it happens in 2030 or 2028 or 2035 are the key things you need to think about. So am I cheering on SpaceX for what vision for humanity they're putting forward? I am. Do I think it's attractive as a medium-term hold from current valuations? I'll be a little skeptical, but this is a retail meme stock, so anything is possible when this thing goes public.
With Elon Musk, right? I mean, how people love to hate him, but you just have to look at his numbers and go, he does something right.
Yeah. You're catching rocket boosters with chopsticks. Yeah. And launching low Earth orbit satellites that is going to provide telecommunications for the whole world. You got to cheer that on, but that doesn't mean you always have to buy the stock blindly. So that's the part where we always struggle with is we love the mission, but the valuation we always struggle to make sense of.
All right, just for fun, 1.75, is that 1.8 trillion now is where it's kind of the number they're settling on right now. Do you think that's where it ends up tomorrow? Where do you think it ends up? Just for
tomorrow?
Yeah.
Yeah. So I'll bet 30 cents on this, no more than that. I'll tell you it ends up north of 2.
No,
And I'll tell you specifically why I get there. The way that the IPO has been structured has been very, very narrow. So plus a decent retail allocation. So Elon's supporters in the retail world are going to be very much involved. And you don't buy this thing to be bearish the next day. So I bet you there are more buyers than sellers. And then the institutional allocations, which is the broad thrust of the IPO, and it's a huge IPO. It should not be forgotten that this is the largest IPO we've seen, outside of maybe Aramco. The institutional allocation, Roger, is very tight as well. So I think it's set up to pop, but it goes back to that's a tomorrow conversation. And that's why I'm only betting 30 cents on it.
all right, we'll leave it at that. Dan, always a pleasure to talk to you, sir.
Pleasure. Good to see you. Dan
Rohinton, portfolio manager at IA Global Asset Management. Coming up, a social media ban for kids under 16 in Canada has been tabled in the House of Commons. We'll take a closer look at what that could mean after the break. Multiple reports indicate the federal government is planning to introduce a social media ban for those under the age of 16. The new online safety legislation would force social media to block access for kids, though platforms will be able to obtain an exemption if they put sufficient safeguards in place. For more, we sat down earlier with Renee Black, founder and CEO of Goodbot.
We're happy to see a new online safety bill coming out. This is the third time that this bill has been introduced. I think there's been a lot learned since the first versions of the bill were introduced. I think right now the push towards age gating is a trend. Australia has done a version of age gating now, and they've had some early data to suggest, it's kind of working in some ways. I think about 30% of the people, kids in Australia who might have been affected by that have gone off, and others have actually found workarounds like VPNs to try to stay on social media platforms. But that's not insignificant, and so a lot of the question is how might an age gating implementation take place? And really another question that we would be wanting to ask is what else is going to be complementing a bill beyond age gating, because there are some really inherently problematic practices in some of the social media platforms that we would want to see addressed in addition to age gating.
Give us a sense of what those problems are, at least in your view, or at least one of the main ones too outside of age gating.
Yeah, I think when we're talking about young people, really, there's been several critical issues. One is social media addiction. Some recent court cases in the U.S. and New Mexico and San Francisco found that there's intentional attempts to use design practices like infinite scroll to try to keep kids on screens longer. And it was very much intentionally trying to keep people on screens and promote a sense of addiction, keep you wanting to come back. So even when you're not on the application, you're kind of constantly thinking about what is going on there and wanting to come back. So it's occupying a lot of time in your life. And so this is very destructive. It sort of really impacts our personal relationships. It impacts our ability to concentrate. And so, that's just one, but there's also design practices that make it easier for people that we don't know to contact us. And that can be particularly risky when it comes to strangers trying to interact with children who might have, malicious intentions.
I'm curious too, you touched on Australia too as well, right? And the number of kids and under the age of 16 that are trying to circumvent this, whether it's VPNs or otherwise. It feels like that if Canada institutes a complete ban, that we would face those same struggles here right now until the generation of younger kids who is not necessarily on social media. It's going to take years, right, for this to actually really be fully in effect. Do you expect the same that we could see here in Canada if this ban is initiated?
It really depends, again, on how it's done. For example, if you have a device level verification mechanism, where basically the device itself is basically what's indicating the the age of a person, rather than every attempt to go onto a platform, then that's a bit more of a holistic way, because then you avoid having to overly disclose your age information to every publisher, and you might even have a way to sort of age gate it. So it used to have to be that if you want to unlock a SIM card, you had to go into a store to kind of get them to unlock that SIM card. You could have a version of that where you bring in an ID, and then once you hit the age of majority, whatever that ends up being, then you can unlock unlock that device to be able to use that. So that would make it harder to use VPNs because that would be happening at a device level, but then somebody can also get another device. I think that the key thing is it's not, people are going to find ways around. Doesn't mean that you don't do it. It means that maybe you sometimes need multiple ways of trying to deal with the issues. But, again, I think that age verification is just one of the issues. We also need to deal with these very toxic and problematic practices. If we deal with a lot of those practices, then we need age verification less than we did. Like we have less ability for strangers to interact with children. If you have age appropriate design, then there's also less of a risk for not only young people but everyone else.
And let's touch on that too for a sec, because Apple feels like they're trying to maybe take a little bit of action in that, right along that route. Just recently unveiling right at WWDC some of their, you talk about it, that age verification, being able to put limits on what kids can access depending on how old they are, and putting a lot more measures into place. It feels like, again, some of the responsibility needs to go on these tech giants, and it appears that at least one of them is trying to at least start out in how they're going to approach that.
Yeah, I think that Apple, so one of the things that the European Union is trying to do is they're trying to implement a digital ID. And in that digital ID, there's a couple of different ways you can go about it. One is called selective disclosure. So every digital ID has selective disclosure. That means that when you are verifying who you are, that you are disclosing certain types of information that is maybe required in a particular context. There's also this idea of zero knowledge proof. So zero knowledge proof would basically ask the question, are you over 18? So in the case of maybe somebody accessing an adult content site like Pornhub or something like that, and they would just be a binary, yes, no, this person is old enough. And so we really think that that privacy respecting approach, zero knowledge proof models, are the most privacy respecting ways, because what we don't want to see end up happening is companies or third-party vendors that do age verification suddenly incentivized to collect a lot more information on young people or anyone else, because that puts us all at risk. So I think we want to find out ways to do this verification without infringing on privacy.
I was talking with Renee Black, founder and CEO of Goodbot. Up next, the latest estimate for SpaceX to price will come after 4 p.m. today. We'll see what happens with that. Donald Trump has signaled he is not looking to renew a trade deal with Canada, adding, as he has said before, the U.S. doesn't need anything Canada has. His comments come as the Prime Minister was briefing premiers on the status of the CUSMA trade. CTV's Abigail Beeman has more.
Well, I'm not looking to renew it.
Donald Trump muses he's not interested in renewing the North American Free Trade Pact as Canada pushes for a full 16-year extension.
I don't know that I'm going to renew it because, to be honest with you, the United States does much better. Hey, we don't need anything that Canada has.
This on the heels of Canada-U.S. Trade Minister Dominic LeBlanc's trip to Washington to meet counterpart Jameson Greer.
I'm eternally optimistic, Abigail.
And Ontario Premier Doug Ford's attempt at a D.C. charm offensive with business leaders and lawmakers.
They rolled out the red carpet for us. They treat us so well.
But one unresolved issue, the future of the Gordie Howe Bridge. Today, the Prime Minister seemed to walk back his claim that it's set to open.
No big drama. If it takes a little longer, it'll take a little longer.
While Ford said he hopes Trump changes his mind, and there's currently only a ribbon cutting on the Canadian side.
Basically a ribbon cutting. I'll be attending once we actually open the bridge and we're actually driving across.
The Premier hosting Pennsylvania's governor today, who had this to say about Trump's CUSMA talk.
I do not believe that the president is right in suggesting that we don't need each other. I think our economies are linked.
The July 1st deadline now just weeks away, but experts and officials alike trying to calm concerns, saying after that date, CUSMA won't fall apart, and Americans haven't signaled intent to tear it up. The big problem, ongoing uncertainty.
I've met a lot of Democrats and Republicans on my quick visit. Every one of them are saying, we got to get this done. We have to start moving. Because when you have uncertainty, investment gets stalled.
No official word from Dominic LeBlanc's office nor the Prime Minister's office. Mark Carney has said a number of times he won't comment every time Trump speaks.
And that was CTV's Abigail Beeman. Well, space stocks are back in focus today with the closely watched IPO set to price, offering a fresh read on investor appetite for the sector after that volatile stretch. Of course, we're talking about SpaceX. For more on what this deal could signal and how it fits into the broader space economy, we are joined by Bloomberg Intelligence Senior Aerospace and Defense Analyst George Ferguson. George, thanks very much for joining us. Is this Christmas Eve for a lot of people?
I guess if you're an owner of space stock shares right now, yes, yes, it is. I think it'll be. I've heard this morning that they're reporting that there's $70 billion of retail interest in the deal. So it seems like it's a done deal, right? Seems like with that, I'm sure there's institutional money ready to come in and buy shares. It seems like it's probably solidly oversubscribed if those reports are correct.
Have we heard who might be interested in buying right now? Any big names that are looking to get in? I was going to say ground floor, but the ground floor was a while ago. But tomorrow, say.
Yeah, I think so. But I'm sure there's plenty of fund managers that will want exposure to it. You know, I think in the first a couple months here, some of the indexes pick up the stock, and so I think some of the fund managers will want to make sure they've got exposure to it because of that. And then the S&P 500 didn't move up their timeline for inclusion, so that takes a bit longer. But again, I think if you've got a tech fund, if you've got a space fund, I think you're going to want to be involved. So I'm sure there's plenty of interest from that institutional side.
And now we're seeing 1.8 trillion. It was as high as 2 trillion, and there are some that are saying it could be actually a little more than that. Some of the analysts are saying that it might go a little higher than that. What is there a general consensus that is the 1.8 pretty accurate?
You know, I mean, in recent days, one of the comparison companies that we've used to value it, Rocket Lab, has come sort of way off their multiples. They were originally sort of 90 times revenue, come down to about 70 times revenue. Those are still super heady valuation points. But I think some of that took a little bit of the shine off the top end. So, I haven't seen sort of Rocket Lab drive any further higher since then. I think right now there are not a lot of opportunities to invest, especially in pure play space. SpaceX won't be pure play space, but maybe if you own some of the pure play space, you sold some of your shares to get involved potentially with SpaceX. I think in the longer run here, just having such a big company that's sort of a space and an AI player, I think that sort of takes down some of the squeeze on demand that's driven up prices.
Got to wrap it up there, George, but thank you very much for joining us. Apologize for cutting that short. That's Bloomberg Intelligence, Aerospace and Defense Analyst George Ferguson. Opening bells are next. All right, there you have it. The opening bells are ringing. Oh, it's going to be an interesting Thursday. The last one before SpaceX, I guess we want to call it that. Forbright ringing the opening bell at the NASDAQ, at the New York Stock Exchange. It's Whitehawk ringing it on their IPO. And Apotex Health in Toronto, TSX, to celebrate its new listing on the Toronto Stock Exchange, one of the largest we've seen in the last 5 years. Time now for the first 15. This is BNN Bloomberg, and trading is just getting underway. Let's check in on the equity markets and see what's happening right now. Oh, nice little bounce back. It's been a roller coaster to say the least, and we'll see where we end up at the end of the day with everything that's unfolding. But for now, the TSX is up 0.65%, S&P 500 0.44%, and the NASDAQ 0.57%. But what a roller coaster it's been. Taking a look at some of the Canadian stocks on the first 15 that we want to look at. First up is Major Drilling, and it is coming off a very good earnings report, and you can see they're being rewarded for it. It is up by about 7.8%. I just want to try and find some of the quick highlights for it that they were talking about. The earnings drivers, EPS beat was a standout, 10 cents compared to 1 cent a year ago. The EBITDA, $28 million, 37% above the prior year period, and 23% above consensus. So major drilling enjoying a nice boost. Another one that we want to talk about, Dollarama as well. And it had a good earnings report. Profit and sales were up from a year ago. People flocking to the store in the first quarter. Same store sales climbed 5.6%. And a 3.5% increase in transactions. Right now, it's up about 8%. And the last one we're going to look at here in is Aurora Cannabis, down 11.76%, even though their net revenue beat estimates. Still taking a hit right now. And for movers south of the border, we're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities Team. Jeff, always good to see you. Oracle is struggling over the data center costs.
It sure is. Yeah, this is the worst performing stock in the S&P 500 so far this morning. It was down as much as 12% in the pre-market session, and looks like it's off to a rough start. Now, they reported results, and the results, if you look at them and take away the amount of money that they're spending, look great. Our earnings per share beat, cloud revenue beat, hardware revenue beat. All up and down the line, it looked pretty good, except when you look at how much money that they are going to spend in the coming year. That is what is really dragging on the stock so far today. Bloomberg Intelligence out with a note this morning, just kind of highlighting that the company had said it is looking at about $40 billion in additional funding for this spend, and it plans to spend about $70 billion over the course of the next year. Now, we have seen other companies, other of the major technology companies in the U.S. come out with very aggressive spending plans over the coming year to build out the data centers, to build out kind of that AI infrastructure. But they haven't always had warm reception. And so in this case, we've got another one, Oracle today, going to spend heavily to build out those data centers. And investors getting the jitters a little bit with the amount of money being spent here.
All right, maybe a few of them pulling some money out to get on the SpaceX roller coaster. Oklo is rising on their DOE preliminary safety approval for a power plant.
That's right. Yeah, Oklo is a nuclear power proponent. They want to build a nuclear power plant in Idaho. And this approval that they got today is a pretty big step along the way for them. This is also one of these companies that had, you see the stock chart there from just a year ago. This is one of these companies that has really, really benefited from the AI build-out and the expectation that power needs in the U.S. are going to be huge with the build-out of all these data centers. This stock was up 220% last year, 120% in 2024, but has really struggled, as you can see with that stock chart so far in 2026. It's down about 25%, but today it is getting a little bit of a lift. This is a company that as I said, does want to kind of tap into the rising power needs of the U.S. and needs to be able to build a power plant in order to do it. Wants to do it in Idaho, and this approval helps get it there today.
All right, Jeff, we'll wrap it up there, but thanks as always for joining us.
Thank you.
Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities Team. Coming up, some ideas for your portfolio after this. Shiraz Ahmad of Sartorial Wealth. It has been a challenging environment for portfolio managers navigating what to buy and sell amid the rapid AI build-out and ongoing geopolitical uncertainty. Let's find out how one portfolio manager is approaching the moment. Joining me now is Shiraz Ahmad, CEO of Sartorial Wealth. Shiraz, always good to see you, sir. Beautiful day, you said, sun shining?
Absolutely.
All
Always
right.
happy when that's happening.
Is the sun shining on the markets right now, though?
I'd say temporarily it looks like a good open, which is always nice to see, but we've been in some choppy waters over the last little bit.
It had, and I'm surprised a little bit at the opening today, considering that choppy waters with Trump today and talking about the Iran maybe heating up again. It's some difficult things. What are you looking for in moments like this and stretches like this?
So there's general guidance that we give to investors, period, which is, this too shall pass, not getting too focused on the minutia on the short term. But of course, as portfolio managers, industry experts, it's our job to keep our finger on the pulse on what's going on. So right now, that's part of the reason why, at least in my business and our practice, we primarily focus on momentum and quantitative strategies to take that human emotional element out of the equation.
And what are you seeing when it comes to momentum? Which sectors are showing like positive, negative?
Well, there's been a lot of rotation happening. So,
Yeah.
I mean, the first part of the year, there was some AI was obviously really big. Software was obviously down. Since then, we've seen a lot of, due to the geopolitical concerns, upwards in energy and even some commodities as well. So right now, it's constantly rotating. So your portfolio needs to breathe with the market.
So what's showing some strength? What's showing some weakness? What are you shying away from?
So in general, I mean, again, software has been under pressure, so it's an area that we've actually just been avoiding, but not necessarily because I or any of our portfolio management team thinks that we don't like them. It's the data. So we primarily invest on price momentum and specifically risk-adjusted return. So a lot of our strategies are based off of that. If it scores well, it's an area that we're going to participate in, and so we're kind of seeing a big swath. So it's a little bit of a mixed bag, frankly.
So with software, because there has been a bit of a bounce back with some software we've seen over the last little bit.
There has been. I think that a lot of these concerns can be overblown, and so the obvious winners and losers are still to be determined, right? AI is still so new. If you think about where we were just 1 year ago to where we are today, it is amazing to see how much progress we've made, and what's that going to look like fast forward a year, 2 years, 3 years. Some of these companies have some pretty big moats around their businesses, so to say that they're just not going to exist tomorrow, I think can be potentially overblown.
All right, but for now, those softwares.
I'd say it's still something to be cautiously optimistic is what I would say.
What's showing some strength right now?
So there's a couple stocks that we like right now that are in our universe that have been coming back up on the screen. So, first one, Apple, household name. We all know it. It's a security that we like right now. It's come back into our portfolio. We've jumped in and out of it over the past year or so. And it's a name, again, that after, sort of the recent, CEO shift that's underway right now, plus, the concerns over some of the integration of Apple Intelligence. Right now, there seems to be some positive price momentum, so it's a security that we're liking to jump in.
Okay, yeah, because there was a little bit of mix on the AI aspect of everybody. I think was expecting something more.
Well, I think they always were. And again, Apple's got this cult-like following behind it, right? And so I think there's a lot of expectations that get built into the cake whenever an Apple says anything. So I think some of that is always, there's a bit of exuberance in there. And so since that's actually come back a little bit, come back down to earth, now there's really the potential for there to be another area, another sleeve in their ecosystem that they can actually get more renewals and more sales out of.
And what do you think will be driving that? Where?
Well, it's to be determined, but I think the iPhone's obviously going to be a big part of it. I mean, that's something that every couple of years people go through their refresh cycle, and this could be another area that it could get into if you want to make sure that your phone is up to date so it can take advantage of all the new changes.
And with the AI, not so many concerns about it?
To be determined, right? It's still new. I mean, the whole deal with Google and Gemini in the background, a lot of it is to be determined. I mean, the Worldwide Development Conference, there's a lot of expectations that came out of that, and I think a lot of it will be to be determined.
All right. And the other one you're looking at going the other way, Novartis?
Yes.
Not really going the other way, but a different sector.
Absolutely. So, again, healthcare provider, I mean, we like where the direction that the firm has gone. If you look at how the company has changed dynamically over the last couple of years, they've really kind of dug in their heels and gone into the innovative side of the pharma space. So overall, getting rid of their Sandoz division a couple years back was a great idea. And we like the fact that they're really focusing in on some of those innovative therapies.
What's showing up for them for some of those? Where's the focus with the therapies?
There's a lot in immunology. There's some in oncology as well. Again, they've been really dialing in on some of these sort of just-in-time inventory style of some of their newest drugs that they're releasing. So again, there was some concern about some of the patent runoff that was happening earlier in the year. I think a lot of that is to a degree subsided, and the guidance is looking pretty positive overall. So the momentum's picked back up on the stock. So it's one that we'd like to jump back in on.
And with Novartis and the healthcare industry, AI, do you see that?
Early days still, frankly. Yeah. I mean, again, adoption of AI across the board hasn't been done in every industry. There's some that are way ahead of the curve. For example, automation and whatnot has been there. But within the healthcare, they are sort of taking in some positions, but it's not an area that's going to be huge, at least in the short term.
For now, because that's one of the things people talked about. You still think there's a lot more opportunity.
Oh, absolutely. So if you look at how even your average user is even using AI, a lot of them are still relying on just this simple basic chat functionality. But now that you can actually implement automation, it can take over. But there's still the concerns about like how good is it? How accurate is it? Yeah. You still have to fact check. You still need strong, intelligent human eyes to look at it.
All right. And healthcare as a whole, which way?
I think we're fairly agnostic, frankly. I mean, right now it's where the data tells us that there's opportunity sets. I think right now with our aging demographic, especially North America, I think there's still a lot of legs left in it. So I don't think it's a story that's over yet.
All right, but and so there's room for it. Is there anyone that's really standing out right now? Any sector that?
Not necessarily. I mean,
trending up. Or?
Energy's been there, but I mean, we another stock we like to talk a little bit about was Rio Tinto, and again on the commodity side of the fence. Frankly, if you're concerned about inflation, sometimes these types of securities can actually outperform as a result of what's going on geopolitically. On our side, it's had positive price momentum coming into it over the last little while. So it's a name that we wanted to jump in on, and we do think that there's still a lot more legs with it as well.
And what's driving the momentum on it?
There's a lot of different ones. So they have some new projects that are coming online in Africa that are being able to ship as well. So, again, iron ore, copper, aluminum, they have a lot of the base materials that we need. So, we've talked in the past about sort of the whole picks and shovels thing. This is like the wood and the metal that goes into the picks and shovels. So it's another way to play in on that ongoing theme, because we need these base materials in order to be able to actually continue to expand our growth strategies.
And it feels a bit like Rio Tinto's a name I haven't heard mentioned in a while. Or it's kind of been just staying in the background.
They're just kind of always there, right? So they're in the background. They provide the stuff that we need. And they're one of the largest producers on the planet. So it's a reasonably safe way to play some of those sort of base material needs.
All right, we got to wrap it up there, Shiraz. Always a pleasure. Thank you for joining us.
My pleasure.
Appreciate it. And that was Shiraz Ahmad, CEO of Sartorial Wealth. Yesterday on Market Call, we were joined by Kim Bolton. He is president and portfolio manager at Black Swan Dextertis. He was covering technology stocks. His top picks were ARM Holdings, IBM, and Tesla. Today on the show, we have Stan Wong. He's portfolio manager at Scotia Wealth Management, and we'll be taking your questions on North American large caps and ETFs. Just ahead, we'll turn our attention back to the uncertainty that U.S. President Donald Trump has cast over the CUSMA trade deal. Is this just another page in his negotiation playbook, or a real shift that could have lasting implications? More on that next. Trump is again threatening to not renew CUSMA with Canada and Mexico. Meanwhile, Prime Minister Mark Carney says the Gordie Howe Bridge connecting Ontario and Michigan might not open at the end of the week as initially promised. For more on this, we're joined by CTV's Judy Trin. Judy, thanks as always for joining us. Just, I guess, another day in politics, right? Let's start with Donald Trump. That says it all, I think, that sigh right
my head,
there.
Right? Yes.
What's the latest from the president?
Well, Roger, yesterday Donald Trump said that he doesn't want to renew the CUSMA agreement, the North American Free Trade Agreement between Canada, U.S. and Mexico, which comes up for review on July 1st. So this statement comes just days before that deadline. What we know is that Donald Trump has said repeatedly that he feels that the U.S. Is not getting a fair deal, that they're in a trade deficit situation with Canada, and he wants to correct that. What we also know is that he will use anything in terms of a leverage point as Canada enters into these negotiations. We know that Canada has also made concessions in terms of breaking the logjam on negotiations and discussions. For example, Mark Carney has withdrawn the digital services tax that big tech did not like. He has also delayed the implementation of the Online Streaming Act, which also the U.S. had made a big deal about. He has not made a deal on the F-35s. So Mark Carney, the Canadian government, is also looking at its leverage points. And that is where we are at. And now the Gordie Howe International Bridge is also a contentious issue and a major leverage point. Roger?
And with the Gordie Howe Bridge, it was supposed to open. Trump has not been happy with it, says Canada owns it. Do we have a date? Do we have any reasons as why to the delay?
Well, that is drama. Take a listen to what the Prime Minister said yesterday. I want to point out that initially on Monday, he said the bridge was set to open next week, but he walked that back yesterday. Take a listen.
Everyone's working hard to make sure the bridge is open as soon as possible. There's no big drama. If it takes a little longer, it'll take a little longer, but this will benefit Canadians, Americans, business, tourists, residents for decades and decades to come.
Just this morning, we received a statement from the CEO of the Gordie Howe International Bridge. In the statement, it says the bridge is a vital economic link for Canada and the U.S. Canada and the United States have agreed to delay the opening of the bridge, taking the necessary time to resolve any outstanding issues. We appreciate the efforts of the workers on both sides of the border to get the bridge to its current state of readiness. Now, Roger, those words are important because it hints at something. The bridge is ready. The bridge is ready. The workers are in place. The infrastructure has been checked. However, there are political issues behind the scenes that are blocking its opening, and that has to be resolved. As you mentioned, Donald Trump is unhappy that the U.S., Michigan State, is not getting any tolls for about 38 years. And the reason for that is that the federal government, the Canadian government, paid $6.4 billion to build that bridge. Canada built it and is going to collect tolls for about 4 decades in order to recoup its costs. That was the terms of the deal. However, Donald Trump doesn't like it. So is he using the possibility of collecting tolls for Michigan, for the U.S. as a leverage point to get other concessions from Canada in terms of the CUSMA review, which is coming up on July 1st?
All right, a nice quiet summer ahead. Judy, thank you for that.
You're welcome.
Judy Trin from CTV News. In both Toronto and Vancouver, tickets to FIFA World Cup games are still available, and demand for hotels and short-term accommodation has been lower than many expected. CTV's BC Bureau Chief Andrew Johnson digs into the numbers and what it all means for the host cities.
Noah Reitman regularly rents out the top floor of his house on Airbnb. He, like many in Vancouver, figured demand during the World Cup would be off the charts.
And we thought, oh, this will be a great opportunity for sure to make some extra cash.
But after initially significantly raising his asking price, he dropped it back down, and most of his June bookings have nothing to do with soccer.
A lot of the people that ended up signing up ended up not even knowing that the World Cup was going on here in Vancouver.
When it comes to hotels, stats from real estate analytics group CoStar show Vancouver and Guadalajara, Mexico, are actually leading the tournament in hotel occupancy on game days at just under 48%, and Toronto isn't far behind at 47.3%. San Francisco is the only American city more than 40% booked, but a closer look at the data paints a more negative picture. Vancouver occupancy is down dramatically from last June when the city was 64.5% booked. It's a drop of more than 25%, explained by one sports economist this way.
For every tourist that comes in that says, hey, I'm going to spend $1 here, there's probably a tourist that would have been coming to Vancouver in June that said, I'm no longer coming. Because the World Cup is going to be there, I don't want to be around that chaos.
Toronto's data is similar. The city's hotels, according to CoStar, were close to 60% booked on the days measured in June 2025. And during FIFA, occupancy currently sits at just over 47%, a drop of almost 21%. In Vancouver, the hospitality sector believes last-minute bookings will still make a big difference.
It's exactly what we thought was going to happen, is that bookings have been increasing week over week, double digits. Now, we're still behind, but we've gained a massive amount of ground.
Destination Vancouver feels many fans who have match tickets are waiting on booking a hotel to see if prices go down. Airbnb points out 70 to 80% of its listings still available are priced below $500 per night, if you consider that affordable. Andrew Johnson, CTV News, Vancouver.
Coming up, we'll take a look at some of the notable calls for today, including a downgrade for Nutrien. That's when we come back. Time for notable calls. Our first one is from about the Royal Bank of Canada. Argus raised the firm's price target on Royal Bank to $225 from $180. Keeps a buy rating on the shares after The Q2 results showed 11% revenue growth. The company's medium-term financial goals are obtainable and continue to point to best-in-class financial return metrics among Canadian banks, the analyst tells investors in a research note. Argus adds it expects better loan growth and capital markets revenue from Royal Bank of Canada in FY26. Our second notable call, TransAlta. TD Securities resumed coverage of TransAlta with a buy rating and a $26 price target following the completion of a bought deal equity offering. The firm attributes the 13% pullback since TransAlta's Colorado gas-fired acquisition announcement to asset characteristics and full valuation, but it views the deal as consistent with TransAlta's desire to grow in the western U.S. and continues to anticipate near-term progress on the broader Alberta data center opportunity. And our third call, Nutrien. Berenberg downgrading Nutrien to hold from buy with a price target of $65, up from $61. The company is likely to deliver another year of solid earnings supported by elevated fertilizer prices and a recovered retail business, the analyst tells investors in a research note. However, the firm is concerned that consensus estimates will continue to anchor on earnings levels that remain above mid-cycle. The debate is no longer whether fertilizer earnings will normalize, but where normalized earnings will ultimately settle. Coming up, we'll break down the latest market moves and share fresh insights on the AI trade. That's next. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following for you in the BNN Bloomberg newsroom. Shares of Dollarama are rallying today after the discount retailer reported increased revenue and profit in its most recent quarter that beat expectations. Dollarama saw first quarter sales surge 21%, while profit jumped by 17%. The company says the quarter was driven by business in Canada with strong demand for consumables and general merchandise. Transat's second quarter results failed to meet estimates. Revenue came in below expectations, while adjusted profit also saw a decline. The airline operator says rising fuel prices caused by the Iranian war and flight suspensions to Cuba were key factors. It intends to apply for the new federal funding program to offset the impact of fuel costs. Transat has also implemented surcharges on new bookings to mitigate that effect. Oracle shares continued to slide today despite beating revenue and profit estimates. The software company's revenue was up by 21% in the fourth quarter, and it also raised its profit forecast for the year. However, investors seem to be showing concern about Oracle's plans to raise more money to finance its build-out of data centers for AI. Oracle says it foresees raising an additional $40 billion through debt and equity financing. All right, quick look at the markets. You can see the TSX enjoying a nice surge right now. It's up by a little more than 1%, being led by consumer discretionary and energy. Tech, though, is down again. I was just looking at it for the year, and it's off for the year by 20%, the tech sector. Down in the States, let's take a look there, see how things are doing. Green there as well. Solidly, even with everything that's unfolding in the Middle East, the S&P 500 up by 0.78, and the NASDAQ is up by 1.1. Some software sector headwinds there. Okay, the AI trade has been going through a rough patch, especially the chip sector. Micron, for example, was trading for over $1,000 last week, then sold off along with other chip stocks. Where is it at right now? It's at $9.12, so it's off about 10% roughly, but you can see it's up a little bit today. All of this triggered by cautious guidance, macroeconomic pressures. Should you buy on the dip, or is the AI trade showing signs of that word, a bubble? Let's bring in Lyle Stein, president of Forvest Global Wealth Management, talk a little bit more about that. Lyle, thanks as always for joining us.
Good morning.
All right, I've now seen it for a couple of days, maybe a little more than that. Bubble showing up. People are talking that. Your thoughts on it?
Yeah, bubbles are always difficult to call. The question that I think investors have to focus on is, what did we buy when we got the enthusiasm? And let's just look at the chip stocks. I mean, they're all up, 200, 300, 400 kind of percent over the course of the last few months. But what did we buy? And now I think investors are now looking at, well, what am I really going to get? It was easy to buy on great expectations, but now expectations are not coming through as people expected. You look at Oracle, just as an example today. It had good numbers, but they need to raise more money. And if you raise more money, you have to earn a return on that money. And these software companies, or even these hardware companies, potentially could see margin pressures going forward on the capital they're raising. And I think that's all coming into the market. And frankly, they've done so well that you take some chips off the table. And, just as an example, we sold some Micron last week in and around these levels on the basis that we've had a spectacular move and the stocks simply look tired.
It feels like a lot of people are thinking that. So does that mean there's more of a downward trend still ahead for it then?
Yeah, one of the things I learned a long time ago was ask yourself, who am I buying a share from when you buy it, and who am I selling it to when I want to get out? We all learn, buy the dips, buy when it's panicking. Well, that's basically an answer to the question, who am I buying from? But now, if you're stepping into the market, who are you buying from? And the reality is everybody knows this trade. The stocks have done spectacularly well. At the margin, people are selling. And if you didn't buy Micron at $400 not too long ago, you're not going to buy it at $900, down 10%, 12% from its all-time high. You're not going to buy it until it probably gets back down to $400. So we're just seeing an absence of buyers because everybody's in, and the sellers at the margin dominate.
All right. Are there any ones of interest, though, that you have an eye on?
Well, actually, Micron comes to mind. It is in the hot area of the market. We own Google, and we bought Google and Micron specifically for the inference component, the notion that there's compute in the chip world, and then there's inference, which is memory for all practical purposes. And so we've been playing that. We trimmed Micron. I could buy it back lower, much lower, I would say. Broadcom is another name we talked about as well. Broadcom is a fine story. Doesn't look like they need to raise money, and they trade at a decent multiple, but the growth is spectacular. So we're now sorting out the chips and asking ourselves, which areas do we want to be in? We think memory is probably the best place to be at this point in the cycle.
All right, and emerging markets, one that comes up, a Korea ETF that you're liking. Korea, is it not for it's not for the weak of stomach, is it?
No, and the reason is it's a backdoor way to buy the two largest memory manufacturers in the world, Samsung and Hynix. Very difficult shares for a North American to buy, expensive to buy. Buying an ETF that is 50% those two shares is kind of a backdoor way to get into the value side of this memory trade.
And not too worried. I mean, it's been meteoric for those two over the last little while. You still think there's room then to run?
Well, it's all been meteoric. And yeah, if you're going to play it, you want to play it for the near-term earnings. I mean, here's the way we kind of look at it, Roger. These stocks are trading at 10 times earnings. We bought them when they were 5 or 6 times earnings. The earnings, if they come through as expected, are going to be spectacular. So that's a good thing, but you're only paying 8 times earnings as opposed to 30 times or more for other chip-related stocks. So it's a value way to take advantage of the cash flows that will be generated by these companies in 26, 27, and maybe even 28.
All right, and out of tech for a second, Stryker's another one you're liking right now.
Yeah, we were looking at downtrodden stocks. And, the question is, we've made a lot of money in names. What areas are not in favor? And healthcare comes to mind. Healthcare, nobody really wanted. They've gone through struggles. Spending in the U.S. on healthcare, you're not getting the government reimbursements and the like. Stryker being the appliance, the knees and hips people. We like that business. We like the aging population theme. They're a direct route into that, and the stock was absolutely destroyed. So when it got down below $190, we started buying, and it's a name that isn't in chip space. It's a name that money can flow to as opposed to flow from. We think the selling is over.
All right. And just one last question when it comes to your portfolio, cash. Is it king right now for you?
Yeah, we have more. We like to always have a cushion to buy 2 or 3 positions. That's generally 5 to 6% cash. But with the sale of Micron last week, and actually we trimmed some gold shares yesterday, simply because we can't quite figure out bullion. And the gold shares are levered to bullion, and we've done really well. And so if you've done really well, take some money off the table and wait and see if you can figure out where the next move is going to be.
All right, and I've got 30 seconds. SpaceX, go. What do you think?
No play from our front. It's way too soon. It needs to be seasoned.
All right, I think
Good luck for those playing.
All right, Lau, we'll wrap it up there. Thanks as always for joining us.
Take care.
Lau Stein, president of Forvest Global Wealth Management. Coming up, the U.S. president says America won't be renewing Kuzma. We'll get more on that after the break. U.S. President Donald Trump says he's not looking to renew Kuzma. At a media event yesterday, he said, "We don't need anything that Canada or Mexico has." Here to break down what this means for Canada is Michael McAdoo, partner and director, global trade and investment at the Boston Consulting Group. Michael, thank you very much for joining us.
Thanks for having me.
Okay, does the president need us, or is it accurate?
Economically, of course, the United States needs 2 of its 4 largest trading partners, being Canada and Mexico. And actually, the president didn't say anything new. There was, under the original Kuzma agreement, which he signed, a renewal clause, which said that unless all 3 parties agreed to renew the agreement on July 1st of this year, review process would begin, which means the 3 ministers would get together and decide how to improve the agreement. So that's been going on since well before July the 1st. And so there's really no news in what he said yesterday.
So really, this is just one of his posturing again?
Well, I don't want to comment on his motives. I just think it's not new news, and we're in a review process. And I would point out that even the Biden administration signaled that it intended not to simply renew, but actually to try to improve the agreement. So that's been going on with more formalized talks with Mexico, and also talks ongoing with Canada over the past many months.
I mean, essentially, that's healthy, isn't it? I mean, everybody needs to, no matter what the agreement is, you have to, even I think if you have a wedding agreement, you should probably take time to look at it every once in a while and make sure everything is working for everybody involved.
That's right. And, I think when you look at what happened last year, there were those big 25% tariffs announced at the end of January. There was a 30-day pause. And the U.S. actually put tariffs on Canada and Mexico of 25% for exactly 72 hours. And then they came forward with the Kuzma exemption. And what happened there was the supply chains in North America are so integrated across the 3 countries that what the U.S. imports from Canada and Mexico, aside from energy and agricultural products, is actually inputs to U.S. manufacturing. And literally, American manufacturers were telling the White House, if you continue with these tariffs, we'll be sending workers home because we can't build products with parts that cost 25% more.
Now, could those be disentangled fairly easily, though, if this pressure from the president continues, or are they literally too intertwined?
I mean, at this point, major capital has been deployed over 30 years, first under the original NAFTA agreement, then later under Kuzma. And in a lot of these industries, these CapEx decisions are very long-term. They can be certainly years and in several cases, decades. And so to unwind that is very difficult. Also, I think what businesses are looking for is stability in the tariff regime. So if let's say you wanted to try to do a new CapEx project in the U.S., the first thing the board of directors is going to ask management is, what's your assumption on tariffs for the inputs for this factory? And management will say, well, at this point, it's all coming in under zero-rated duties from Canada and Mexico under the Kuzma exemption, but there's a review process, and maybe there'll be a forced labor tariff, maybe there'll be a Section 301 tariff, and so there's no certainty on the tariff environment, so it's hard to make those CapEx decisions.
But the companies have been doing things, haven't they? They haven't just been sitting there waiting, going, oh, what's next? Are we going to have a deal or are we not going to have a deal? They have been doing things, haven't they?
Well, what we've seen is companies that have similar facilities across the three markets in North America, the three economies. If you have idle capacity in the U.S. and you're making something in Canada that you could make there, you might try to move that production to avoid a tariff on steel, aluminum, automotive, some of the tariffs that are still in place and that don't qualify for CUSMA exemption. But in terms of new capex, actually building a brand new factory in the United States to build something there, we've not seen that. In fact, foreign investment is way up in the U.S., but it's driven by data centers. If you extract the data centers, other sectors are actually quite far down. So we're not seeing brand new capex happening in the U.S. at this point.
For Canadian business and companies, to a degree, is this a good thing, this pressure from President Trump? Is it getting them to take a look at their companies and see how they run and see how they're run?
I think anything that forces you to look at where your markets are, where your sourcing is, I think is really important. If you think about a very basic value chain, in manufacturing, I source from somewhere, I transform or add value, and I sell somewhere. We've had it really easy selling into the U.S. market with no impediments to that over decades. Now, if you're in the steel sector, aluminum, and automotive, you've got a complex web of tariffs to manage. Other sectors, you're under the CUSMA exemption, as I mentioned. But this will force Canadian companies to look at their efficiency, to look at alternative markets. Canada's got a fabulous network of free trade agreements, but we've not been as good as we should have been about operationalizing that from a sales and distribution perspective and a sourcing perspective. So there's a lot that Canadian companies can do in this environment.
And are we taking advantage of that? I mean, that's been the big push. It got the prime minister elected, essentially, that we're going to find alternative markets. And it's been more than a year. Are we starting to see movement in that direction? I mean, it doesn't happen overnight, obviously.
That's right. I think if you look at the types of trade missions that have been run, I was part of the Canadian trade mission to Mexico, the largest in history. There were literally hundreds of companies and thousands of meetings. And so those relationships are building. Mexico is an obvious place for Canada to grow its trade. That side of the North American triangle has been a bit underperforming versus the bilateral sides with the U.S. and those two countries. And so that's an obvious one. We've also seen a lot happening with India in terms of getting back to a more normal trading relationship with the largest population country in the world with a great growth trajectory. So those are ones I'd look at. And of course, Europe is always there. Canada and Europe very close culturally. There's a free trade agreement. There's common languages with several European countries. So I think those are the bigger markets that Canadian companies should be looking at.
And are they moving to it? I mean, do we have that drive in Canadian companies to go beyond the U.S.?
I think it depends on the company. I think for certain types of products, there's big opportunities in those markets. For others, just due to distance or compatibility, the U.S. will still be an important market. And let's be clear, I don't think we'll ever be able to get away from the U.S. We're just too close economically, culturally, linguistically, and so on. And so no one's talking about, necessarily aiming to reduce the U.S. It's about growing those other markets. And so I think we need to learn to do both of those things.
All right, and one of the other things that's been talked about for a while now, it's kind of been quiet for the last little while, interprovincial trade barriers. They were going to be torn down and we're going to move between provinces. That seems like that has stalled, or is it happening behind the scenes?
I think the federal government is doing almost everything that it can, and I think some of the provinces are showing a lot of leadership in that area. I would point to Ontario as one that's been quite open about this. I think over time people realize that that's a big opportunity as well. I think there's some good studies from the University of Calgary about how much that will actually increase Canadian GDP, and that can offset a little bit some market access that we might lose to the U.S. over time as this administration continues.
All right, but there are challenges to it as well. Michael, we're out of time. Thank you very much for joining us.
Thanks for having me.
Michael McAdoo is partner and director, global trade and investment at Boston Consulting Group. Coming up, 3 ETFs to build a more robust and diversified portfolio. We look at emerging markets, fixed income, and equities right after the break. Let's take a quick look at the markets and see how things are moving right now. Well, first up, we'll go to the TSX. And this is S&P 500 and NASDAQ. TSX in the gray. Everybody's in the green today, although we're slipping down south of the border. TSX is still pretty solid right now. It's up by about 0.8%, being led by consumer discretionary, materials as well. Only one in the red I'm looking at in the sectors is healthcare. And some of the leaders right now, 5N plus Dollarama on their earnings report, 5N plus up by 9.4 and Dollarama around 7.9%. And let's take a look now at oil and see where oil sits with everything that's unfolding in the Middle East right now. It's pretty much flat for the day, right around $90 a barrel, only up by 0.1% despite those threats by President Trump. The latest on, he says the United States will be hitting Iran, whose Navy, Air Force, radar, anti-aircraft, and all other forms of defense, together with most of its offensive capability, are gone very hard tonight. At some point in the not-too-distant future, we will be taking Carg Island and other oil infrastructure points and assume total control of their oil and gas markets, much like we have with Venezuela, which is working brilliantly for both Venezuela and the United States. Thank you for your attention to this matter, President Donald J. Trump. Excuse me, but right now, oil's sitting pretty much flat. Let's take a look at gold and see how gold's responding to that. And gold's off again. Look at that, below 4,100, down another percentage point, pushing back down towards 4,000. We'll see what happens with that. The dollar right now. And it's off about a half percentage point at 71.37. And Bitcoin, we're going to take a look at Bitcoin. We weren't sure, but it's bouncing back a little bit, but still well off its highs that we saw at the end of last year, the fall of last year. It's up today 1.76% at about 62,800, 62,900. And we have more coming up on BNN Bloomberg after the break. Okay, it's time now for the ETF report. We have 3 ETFs to diversify AI exposure beyond the U.S., protect against inflation, and benefit from an earnings beat. Let's find out which ones they are with Gargi Chowdhury, Chief Investment and Portfolio Strategist, Americas at BlackRock. Gargi, thank you very much for joining us today.
Hi, Roger. Great to be here. Thank you for having me.
Let's just talk a bigger picture for a second. The S&P 500 up, I'm just looking at the numbers depending on today, but 27% roughly, best quarter in 5 years. You say the rally's grounded in fundamentals. Tell me why.
Absolutely. So if we look at what has been driving markets this year, let's first focus on most recent earnings season, right? Whether you look at just the sectors that drove earnings, whether you look at the breadth of where those returns came from, the news is fairly positive. What the markets are telling us is that this is not about anything fundamental. It's really around a structural shift that's taking place that's related to AI. And you're seeing that earnings growth come through and really bolster returns. And frankly, it's not just about the past earnings season. It's also what companies are telling us about the future outlook. And again, what we're finding is that companies are consistently continuing to spend on CapEx. Companies are continuing to sort of project that into higher earnings further in the quarters ahead. So that actually points to, perhaps some volatility that's always to be expected in equities, but we think that points to a market that's going to continue to be resilient, especially around those large cap and AI themes.
Okay, and you say there's a strong correlation between stocks and bonds, and investors need diversified diversifiers.
Absolutely. So one of the things that has been coming up in my conversations with clients in Canada as well as the United States is just this idea that especially in periods of market volatility, so let's think about a few days in the past weeks or even the month of March, one of the things that we saw was that traditional bonds perhaps did not work as well as they had in other periods. And there are several reasons for this. Obviously, inflation staying higher for longer is one. Bonds don't have those fantastic returns in periods where inflation is higher. And what we're telling our clients to do is twofold. Number one, certainly remember that income has a place in your portfolio. Look at ETF tickers like XFlex, XFLX that give you that income. But at the same time, recognize that you need other diversifiers. And this is where perhaps asset classes like gold can play a role in your portfolio as well. And then recognizing that you need a diversified portfolio. So go to emerging markets, go to the US, and obviously have that broad portfolio exposure, things like XEQT.
All right, let's talk a little bit about that, the emerging markets. South Korea has been on fire. Where are you looking, and with the move there?
Yes, you raise a really important point. South Korea has been a big driver of emerging market returns. Back in the day, let's think 5 years ago, when you thought about emerging markets, you played in emerging markets, or you allocated to emerging markets because you were really playing for that manufacturing story. You were really looking at that growth coming from these emerging markets and wanting to participate in that growth. It was perhaps very manufacturing-led, value-oriented. And that story is shifting meaningfully. Now, when you look at this new emerging market, what you're getting is about a 40% allocation. If you're looking at a ticker like XEC, what you're getting is an allocation to that AI trade. So what we're hearing from clients is, if you are under allocated to emerging markets, which many clients across the region are, you have an inadvertent under allocation to AI. So really, as a way to plug that gap, to get back to your benchmark, we are telling investors, look, diversify outside the US into emerging markets, playing for those memory themes, for those semiconductor themes, and doing so in emerging markets is a great way. And of course, you get allocations to things like China and Korea, all of which are a big part of that AI trade that we think is structural and here to stay and driving earnings and growth.
All right, and you talked about some fixed income, XFLX. Tell us more about that.
Absolutely. So one of the things that we have seen, especially in the first sort of 5 months of the year, tremendous inflows into both fixed income and equities, one of the quarters in Q1, and partly some of the drivers of those inflows, certainly, the risk appetite that you talked about earlier going into equities, but also focus on income. Now, that income is coming through in asset classes and tickers like XFLX, which again gives you a multi-sector source of income without taking too much interest rate sensitivity. And that is key here. In a world where inflation is a little bit stickier, in a world where interest rates may stay higher for longer, you don't necessarily need that interest rate sensitivity. You don't need that duration. What you do need is income from a variety of sources, from a variety of different parts of the fixed income market. And you need to be able to manage between going from corporate credit to high yield to emerging market bonds to securitized asset. And you need to manage that actively, which is what XFlex does that for you. And we've seen clients allocating that income theme, both in fixed income, of course, as I mentioned, but also, frankly, in equities with dividends themes such as XDIV.
Okay, we want to sneak in, we're almost out of time, but XEQT.
Yeah, absolutely. That's something that, I mentioned earlier. Again, looking at an all-in, looking at a broad, diversified exposure. I'll come back to what I talked about earlier, which is that in this world where oftentimes you see many parts of the equity markets moving together, you want to have as much diversification as possible. Get exposure and allocation to different parts of the world, and XEQT is something that can do that for you.
Okay, Gargi, thank you very much for joining us.
Absolutely. Thank you for having me.
Cheers. Gargi Chowdhury, Chief Investment and Portfolio Strategist, America's BlackRock. Coming up, more on emerging market opportunities, including in the tech sector with Divya Mathur, Portfolio Manager for the Emerging Market Strategy at ClearBridge Investments. That's after this. As geopolitical tensions, economic concerns, and elevated chip valuations weigh on North American markets, could emerging markets offer a timely opportunity for investors? For insight, we turn to Divya Mathur, Portfolio Manager for the Emerging Market Strategy at ClearBridge Investments. Divya, thank you very much for joining us. Can you hear us?
Hi.
Oh,
yep, I can hear you.
Okay,
Hi.
good. Awesome. Thank you very much for joining us. In emerging markets, there's a lot of opportunities. South Korea, I think, is the one everybody's looking at right now. Where are you looking when you're talking? Are there certain areas, certain regions you're looking within that, or just the broader picture?
Well, we look at all the emerging markets, and you're quite right to highlight South Korea and also Taiwan as well, because those two countries are particularly benefiting from this strong global AI infrastructure rollout that we're seeing globally. Over the years that I've been invested in emerging markets, what we're seeing is a real movement to high IP, high intellectual property into emerging markets. And South Korea and Taiwan have some of the leading companies that are operating in the technology space. So for us, South Korea, Taiwan, these are two areas where we're finding lots of interesting opportunities for the long run.
And I mean, with that run that they've seen, obviously you feel there's more room. Are they with South Korea though? Is it not? It's essentially focused on two key stocks, is it not?
Yeah, the South Korean market is quite narrow in terms of the number of companies that are outperforming, but they are highlighted around the two memory companies in particular, SK Hynix and Samsung. But what we're seeing here, and I've been looking at these memory names for nearly 20 years, is we're seeing a very different operating environment for these companies. These companies are moving from being quite cyclical companies with short cycles to being quite long duration, longer term nature in their focus because of what we're seeing. The importance of memory and AI infrastructure is so crucial, and because there is a shortage, it's creating good opportunities for these two companies. So yes, these two companies are doing particularly well, but unlike maybe some of the other parts of the tech market, valuations are still looking attractive for the memory sector. I think there's a myth that these memory companies are very much like they were historically, which is highly cyclical, very uncertain. I think what we're having is a transition at the moment where we're seeing their longer term sort of path being defined. And we're sort of expecting more news in this space just to clarify and just to sort of confirm that fact. And
now you're leaning towards Hynix, though.
We own Hynix and we own Samsung both in the portfolio. We think both of those names are in a very good opportunity. You can't create supply overnight. There's a huge amount of demand for memory. So as a subsector of technology, we find both of those names are in the right place, certainly for the medium to longer term.
And moving over to Taiwan, you're liking Delta Electronics there?
Yeah, so what is always important in investing is diversity and diversifying your exposure. And even with the AI infrastructure theme, we are looking to do that. Delta Electronics has two very important skill sets. It's power management and thermal management. So they have a history of having high market shares when they were involved in PCs, in TVs, in general server, and they've taken that skill and taken it into AI server. So they have a 70% market share in the power supplies for servers. And as we know, as these servers are becoming more powerful, they're requiring more power, and Delta benefits from that. Now, at the same time, we know there's an issue with cooling in data centers. You need to cool the environment of the data center and also at the rack level. And that again, is where Delta has high expertise. So they have found themselves in a very strong position. But their track record has been, and again, this is a company we've followed over 20 years, it's always been a very solid execution, and they're commanding quite high market shares now in this space. So slightly different to the semiconductor side, but again, such a really good, strong opportunity for them going forward.
Okay, and we're going to move over to India and Titan Industries. It sounds like they should be making machines somewhere, but they're actually jewelers.
Exactly, and one market that I think has been forgotten in this AI infrastructure rush at the moment is the Indian market. Now, when you think of India, you do think more of a traditional emerging market. You think of that strong domestic market in terms of the domestic growth, and Titan is a jewelry retailer. Obviously, gold is very important within the Indian cultural perspective, but they also have sort of started to do more higher value added items like diamonds as well. But the reality is that the jewelry market in India is still very fragmented. It's still dominated by those smaller players. It gives great opportunities for well-established brands like Titan to take market share, and that's what it's doing. Its market share is growing slowly every year, but that is creating some great opportunities. We think of emerging markets, we think of India. This is a country which has rising incomes. There's a lot of wealth that's created, and that is going to be spent on luxury items, of which jewelry is one of them. Now, again, Titan has had a fantastic execution in terms of performing in the Indian market. I mean, they've grown their sales over the last 10 years at around 20% per annum, and profits slightly higher. So they are very good operators in that market with a very long pathway in terms of growth.
Okay, Divya, we have to wrap it up there, but thank you for joining us.
Thank you.
Divya Mathur is Portfolio Manager for Emerging Market Strategy at ClearBridge Investments. Coming up in Hot Picks, real estate investment trusts are trying to shake things up and shake off a rough few years. We'll have 3 picks for you right after the break. Time now for Hot Picks, and today we're diving into listed REITs. We've got 3 specific picks covering senior housing, retail shopping centers, and industrial warehouses. Joining us to break it all down is Uma Moriarty, Senior Investment Strategist, Center Square Investment Management. Uma, thank you very much for joining us today. Let's just quickly talk a bigger picture. How's the market looking? I mean, REITs seem to be something that a lot of people were staying away from.
Thanks for having me this morning. And I think you're exactly right. For a long time, because of the interest rate environment, you were seeing a lot of investors really shying away from the REIT market. And what you've seen so far this year is a really fantastic performance for the REITs in comparison to broader equities. And I think that's a function of a couple different things, right? You've really seen the market breadth expand a little bit after getting so concentrated in the tech and AI names. And then on top of that, if you think about what's really happening across the macro environment as it relates to the mounting level of risks that we're seeing from the geopolitical perspective, inflation, what real estate offers for investor portfolios as it relates to diversification, that income that you're really looking for, the yield associated with real estate, and really the hard asset nature of the portfolios that are owned by these listed REITs. So you've really seen strong performance for the REIT sector this year compared to the equity markets because investors are really looking for those attributes to add within their portfolios.
And across the board, things strengthening, or is there still a little up and down?
Of course, there will be puts and takes, right, depending on what the headlines say any given day. But broadly speaking, we are seeing some really strong fundamentals as well on the ground. That earnings growth, that is supporting a lot of what we're seeing in the market performance as well. So you're not really seeing a material deviation, I would say, in terms of the sentiment. We're talking to investors around the world, institutional investors that are really looking forward to deploying capital in the REIT space globally because of what I mentioned, and really seeing the opportunity set within the listed real estate market, especially in comparison to where they could maybe access some of these types of properties in the private real estate market. REITs screen cheap in comparison. So you also have this valuation kicker on top of everything else that's happening.
Okay, let's take a look at some of your picks here. First up, Ventas on the New York Stock Exchange.
Ventas is a really great example of a very strong structural story that is unwinding here in the real estate market, what you can see. And that's really related to what's happening with the aging population, right? We have this aging population, not only in the US, but around the world. And what that means is that you're seeing increasing demand for senior housing, which is really where Ventas plays. And so we're seeing really, really strong internal growth associated with the demand that's coming in for senior housing. At the same time, we have no new supply of senior housing within this country. And so that's creating really strong opportunities for incremental income growth for the Ventas portfolio. And then on top of that, they are trading at a great premium in the marketplace compared to where they can go out and acquire assets in the private market today, which means that they also have a really strong kicker associated with external growth. We're anticipating about $3 billion in acquisitions from this portfolio this year. So between the internal growth driven by fundamentals and the external growth opportunity they have in front of them to really help consolidate this marketplace as well, we have some really strong expectations as it relates to the earnings growth associated with this name. And so this year so far, Ventas has actually underperformed underperformed the REIT market on the back of really strong performance last year. So it's providing a bit of an opportunity here for investors that are looking to get exposure to the senior housing space and be able to do that through a name like Ventas.
Okay, next up, Brixmor.
Brixmor is a really great way to enter the shopping center space here in the U.S. What we've seen since kind of the GFC is that we have not really built new retail in the U.S. At the same time, you've seen population continue to grow. And where Brixmor really plays is in some of the submarkets and the markets in the United States where we've seen really, really strong population growth. So again, taking this back to real estate fundamentals, the supply-demand mismatch in the Brixmor markets is really, really strong and in favor of the Brixmor portfolio. On top of that, this portfolio has some really strong runway that we can see in terms of growth. About 5.3% of their annual base rents are associated with leases that have already been signed, but these tenants have not yet taken occupancy in the spaces. And so we have this kind of built-in rent growth runway that we see for this portfolio. And they're spending a lot of capital in terms of repositioning their portfolio and continuing to grow it to remain competitive and be kind of best in class within their marketplace. And so this is another place where we see some really strong fundamentals on the ground and a great valuation to get into a name like Brixmor.
Okay, we're almost out of time, but First Industrial.
First Industrial, we're really seeing an inflection point in the industrial marketplace. First Industrial is a little bit of a higher beta play from that standpoint because they have a bit more exposure to speculative development, especially in some of the markets like Southern California, where you're starting to see fundamentals really inflect positively. And so First Industrial really is a great way to add some beta within the industrial market and in the REIT space in general.
All right, we'll wrap it up there, Uma, but thank you very much for joining us.
Thanks for having me.
Uma Moriarty is Senior Investment Strategist at Center Square Investment Management. Well, shares of MDA Space are up more than 100% over the past 6 months as the company's earnings growth continues to gain traction among traders and investors. At the same time, Friday's highly anticipated SpaceX IPO is also fueling renewed excitement across the space sector. For more on this, we were joined by Mike Greenlee, CEO of MDA Space from the U.S.-Canada Summit, which is underway in Toronto.
Yeah, I think we have cross-border opportunities in all the areas that we work in. We deliver Earth observation data and information, which is important to customers in the United States, including defense. Space communications, though, is a big boom in business these days with space-based data networks around the world and space-based direct-to-cell networks. The SpaceX of the world get a lot of publicity in terms of what they do with Starlink and the like, but there's a lot of other constellations around the world. They're developing space networks and capability, and our MDA Aurora product, a digital satellites that we build in Montreal here in Canada, have a strong export opportunity around the world. In the area of defense, as defense expands, we have a global defense growing opportunity, but with the United States, there's a strong opportunity to continue our historical collaboration in space, both for civil space and the return to the moon, and in defense, especially as we expand into continental defense and worry about things like Golden Dome and SHIELD and missile detection and prevention here in North America.
Now, you started the year with a $4 billion backlog. Any updates or new wins, that could keep pushing that number higher?
There's been small stuff that's happened along the way, but I think that we'll get into a bit of an order season now as we go through the next couple of quarters. Folks, pursuits and that we've been working on throughout the years so far should mature to the state where we can start to see some orders flowing in that will further expand backlog as we go through the next few quarters.
You touched on it, I think, there too, but give us an update in a little more detail too on the Course Earth observation constellation ahead of the planned launch for it later this year.
Yeah, Course is in a great spot. This is us developing our next generation synthetic aperture radar satellites, 2 satellites, a C-band satellite, which is a broad area surveillance satellite, and an X-band satellite, which is a narrow zoomed in view. They're going to follow each other in orbit when we launch them at the end of the year with our ability to be able to do large scans of the surface of the Earth and then detect things that we want to zoom in on with the following or trailing satellite. This is an exciting evolution in our 4th generation of radar satellites that we've developed over the last several decades, and will tremendously expand our capabilities. We have over 41 customers around the world that have signed letters of intent. I think 9 or 10 of those have already signed their contractual agreements to be able to provide this expanded service from our current RadarSat 2 capability as we move forward into the future.
And what are what feedback are you getting any yet too? I know it's early days, at least for now, but are you getting any feedback from the customers that have signed those agreements so far?
They're just excited and waiting for the capability. A number of people are just getting data and services from us on our RadarSat-2 satellite in anticipation of the Chorus launch at the end of the year.
And when are you expecting, that demand and those agreements, to start flowing, to start turning into some revenue and some earnings?
Yeah, as we go through 2027, we're expecting that to occur. There will be a period of putting commissioning the new satellite capability that we launched in the end of 26. We'll commission that as we start 2027. Take a few months to get that into service, and then it'll start adding revenues to the geointelligence revenue stream.
So you touched on, too, the return to the moon. You have noted that robotics work, tied to the Artemis program continues despite NASA pausing Gateway-related work, with the potential shift toward the lunar surface missions. How does that affect, timelines for you and opportunities for, you mentioned Canadarm3 and MDA Space?
Yeah, we keep pace with those programs, the Canadarm3 program, which is with the Canadian Space Agency. This is one of Canada's contributions to the Artemis program, and that continues at pace to make sure that as the world works with the United States to live and work on the moon, as we go through the rest of the 2020s, so that we're on the moon before 2030, that Canada can be potentially in a position to help out with all of that program. You mentioned the pause in Gateway. That is true, but the program continues at pace while we look to reconfigure that. In addition, you would have seen announcements recently about what's called commercial LEO destinations or commercial space stations. NASA continues its competitive process for various companies to be able to put up and deliver and operate commercial space stations. We have an equity stake in one of those space stations, but we also have a robotics opportunity in all of those space stations to be able to provide our decades-proven robotics and our new MDA Skymaker product, which is a commercial derivative of Canadarm3, into the low Earth orbit commercial space stations that are going to be developed, again, over the next few years, again, before 2030. So a very busy time here as we go through the next 4 or 5 years.
Yeah, I can imagine, and a lot of opportunity, clearly. MDA Space also recently awarded that contract with the Department of National Defense, right, for ground-based optical space surveillance. How significant is defense? I know you touched on it in your first answer, but give us a sense for the overall growth strategy and where it lands.
Yeah, defense is really important. Like, we see definitely geopolitical shifts in the world. One of the things we talk a lot here today at the Canada-U.S. Summit, as countries stand up a little bit taller and worry about themselves just a little bit more. And so, the U.S. is taking care of itself. Other countries are taking care of itself even more. People are standing up a little bit taller, working on defense, security, economic prosperity, for their nations. As a result of that, the opportunities for sovereignty is the big conversation around the world. And from a space perspective, sovereignty means space-based Earth observation, to be able to observe your territory, space-based communication, to bring communications to all your citizens. We have a new product called MDA Midnight, which is a space control product that is a spacecraft to protect other satellites. So these things are all driving demand in defense departments globally. Canada is increasing its defense spend. We're a prime contractor for Canadian Department of National Defense. So we have a lot of opportunities at home and a lot of opportunities to export those capabilities to nations around the world that want to increase their defense and sovereignty.
And Matt, we're speaking with Mike Grinley, CEO of MDA Space, live from the U.S.-Canada Summit. Okay, let's take a quick look at the TSX and see where it's at right now. You can see it's up by about 0.78%. Nice little rebound for pretty much everybody. Is doing well. Every sector, consumer discretionary leading the way, up by 3%, almost 3.2%. Materials up as well. Same with energy. One of the ones we want to take a quick look at, a couple we want to take a look at. Dollarama first up. It's up 8% right now after a nice first quarter, driving strong demand for consumables, general merchandise. Shoppers are searching for value. That helped drive it right now. Same store sales were up 5.6%. And the other one, 5N Plus. And take a look at this. It's up about 6.85%. And it is a mining company that deals with some rare earths in that. And it's been up and down. It's up right now. It's 6.85%, but just last week it was down 11%. Over on the U.S. markets, Oracle is the one to look for there. It is down on its quarterly report. It's the end of the day right now. And so it's struggling right now. That wraps up this edition of The Open. Morning Markets up next.